Well, thanks a lot for coming out today. I'm looking forward to spending a little bit of time with you this afternoon talking about the economy and why I'm pretty bullish about 2013. It's been a long time coming because ever since the credit markets blew up in 2007, I've been kind of walking in and scaring audiences around Texas and around the country, and so it's kind of fun to be on the other side of the equation. I want to run through some things today with you to try to show you why I'm bullish. It doesn't matter whether I am or not. The facts are what matters. So let me run through some of the facts with you that kind of support my point of view. First of all, in my opinion, the U.S. economy really started turning around in the third quarter of 2011. I say a real economic recovery started to happen there as compared to a fake economic recovery when you give people tax credits to buy a house or tax credits to buy a car. People started buying homes, cars, and other retail sales in 2012 because they wanted to, not because of a tax credit. Real estate construction is growing again finally. The residential housing markets in most of the country are stabilizing. There's more people at work. We've got 5 years of pent-up demand, and very importantly, Americans have credit capacity again. We've gone 5 years of delaying decisions, delaying whether to get married or not, delaying whether to have children or not, delaying whether to retire or not, buy a second home, hire workers, merge and acquire other firms. And after 5 years of pent-up demand, people are finally deciding, I think it's time to do something rather than sit on my hands and hide. The biggest thing that I see going forward in 2013 is the housing market has turned the corner. For years, people have been talking about how the housing market is a headwind against economic recovery. Well, I'm from Wichita, Kansas originally, and I know what wind is all about, and I've been outside when a north wind changes to become a south wind and vice versa. That headwind of holding up the economy of housing has shifted direction now, and it's starting to be a tailwind which will actually increase economic activity in our country rather than retard it. I'm anticipating we're going to have more housing starts in 2013 than we did last year. I think some of the starts will be constrained because of a limited labor shortage. It's hard to find workers these days. The housing recovery is going to be limited a little bit by mortgage loan underwriting. It's still hard for a lot of people to get home loans as new purchasers, especially first-time buyers, but I'm confident in 2013 that will start to change as well. I expect that construction costs could increase even further as we start building more houses and other real estate buildings. And I think the second derivative of all of this increase in housing is that it's going to create some demand for commercial real estate that we haven't seen in 5 years or so, specifically for warehouse space and flex industrial space, if you're not, and also suburban office. Think about all those companies that used to support new housing out in the subdivisions. You might have a real estate brokerage firm that has an office, a title insurance company that has an office, a tile company that has a showroom in flex warehouse space. And when the housing market collapsed in 2008, the real estate firm went back to their central office, the title insurance company closed their branch office, the bank closed their branch office, and the tile people shut down their warehouse and distribution area as well. As the housing market starts to expand beginning in 2012 and continuing into 2013 and beyond, that will start to reverse. As housing activity picks up, a real estate broker will want to have a branch office reestablished in that neighborhood, as well as the banker and the title insurance company and the tile person. So I think something that a lot of people aren't really noticing right now is the investment opportunities that might be available for suburban office and suburban warehouse and flex industrial space as the housing market turns the corner. Don't make any mistake. I'm not saying the housing market is getting ready to explode. All I'm saying is it's turned the corner and beginning a long-term stretch of real recovery in the marketplace over a period of years. There are some issues involved in housing that are going to retard that growth. It could be growing a lot faster, but the bottom line is the mortgage market's totally broken. Congress, for whatever reason, has been unwilling and or unable to fix Fannie Mae and Freddie Mac. And so this has gone on for 5 years now, and there is no private mortgage market. It's all government subsidized mortgage money right now. And the question that I have for Congress is, why haven't you fixed it? What's your excuse for not doing that? The housing market's the most important sector of the U.S. economy, and the financing that goes along with that is dependent on Fannie Mae and Freddie Mac. And congressional incompetence has, for whatever reason, refused to fix this issue and repair the mortgage market. Also, another thing that's going to kind of slow down the housing market, even though I'm bullish on it, these are the things that are going to slow it down. Dodd-Frank has a bunch of rules that haven't been written yet for mortgage underwriters. They're unclear about what it takes to write a mortgage. For example, some underwriters are subject to fines. If they make a loan to you for a house and 2 years later you miss a payment because you got sick or you got divorced or lost your job, it's possible that that person that underwrote that mortgage in the first place could get fined for making that loan. And so those rules regarding it's called safe harbor provisions. If you're in the real estate business, one of the best things that you're going to hear in 2013 is if Congress and this Consumer Protection Finance Board, I'm not quite sure what you call it, I call it the Politburo. But if the Politburo can come out with definitions of what's a qualified residential mortgage, that will help to open up the mortgage market a lot further than we experienced in 2012 and are experiencing so far in early 2013. Another issue that's constraining the market is that Fannie Mae and Freddie Mac are aggressively sending back mortgages to people that underwrote them in the first place. That's why appraisers are so nervous when they make appraisals. That's why bankers are so nervous when they make bank loans, because they know if they make a mistake and make you a loan and then you default on it, it's possible that they will get fined and have that mortgage put back on their books as well. And so that makes them nervous about making loans to people with lesser credit ratings. There's a segment of American homebuyers, within the segment of qualified American homebuyers, the top half that have really great credit scores, they're getting mortgages. But the bottom half of those qualified buyers that have lower credit scores because they've got some kind of damaged credit, they're not getting loans right now because the underwriters are afraid of the fines that they might get for making those loans. That'll be one of the greatest things that could happen in the market, is if the Consumer Protection Finance Board issues safe harbor provisions for single-family mortgage underwriting. Let me talk about this too. I think another issue is going to be that the labor pool is somewhat constrained too, because a lot of people moved out of the construction business over the last 4 years, and so a lot of them have migrated into the oil and gas business or into the transportation industries. As demand picks up, it's going to be hard for these home builders to gear up simply from the fact that it's hard to find labor. The great news is that the psychology of buying a home in America is changing pretty dramatically. I would say beginning in 2008, 9, 10, and 11, people would rather stick their hand in a bush of poison ivy rather than buy a house. They were just afraid that it might go down in value, they'd get underwater, they'd get foreclosed upon, like all the stories they heard. Well, that started changing in 2012, in my mind, somewhere around January, February, March. This Conference Board survey asks people across America, are you thinking about buying a home in the next 6 months? And as you can see from this chart, it's grown above 6% for the first time in a long time. Clearly, people are changing their minds about buying homes. It doesn't hurt when you read a headline that home prices in Phoenix are up 30% from a year ago. In fact, can you imagine if you're a 30-year-old man or woman living in Phoenix and you decided to buy a house last year while your friends were buying Zynga and Groupon and Facebook and losing money in the stock market, and you just boringly went out and bought a house, a $100,000 house with a 90% loan at 3.5%? Well, if that house went up 30% in value, that means that $100,000 house went up $30,000. And you have a $10,000 down payment. That's a 300% return on your money. That beats the smithereens out of what kind of return you got on your Facebook purchase when they IPO'd. Big issues for housing in the coming years. I'm convinced that the psychology of buying a home has dramatically improved since 2012. Home price appreciation has resumed across much of America. I will say this, let's be frank, places like Florida and Illinois, they still have problems there. New York, they still have problems there as well. It takes too long to foreclose on homes. They don't know how to clean up the mess. In the state of New York, it takes somewhere between 750 and 1,000 days to foreclose on a home. And so they're unable and unwilling to clean up the mortgage foreclosure mess in those states, and that's why prices aren't responding well. But in other parts of the country where they've gotten with the program and foreclosed on these homes, the market has changed dramatically. Another issue is that the inventory of homes for sale is remarkably low. Most people can't explain this. Frankly, I can't either. I'll show you some slides in a little bit, but typically we at the Real Estate Center have determined that about a 6.5 month supply of inventory is a balanced market where prices increase at a reasonable rate. When you get below 6.5 months, that's when price pressures start to really increase. And many parts of Texas in particular have inventory levels in the 3.5 to 5 month range, which is amazing. And in addition to having inventories low, it's the limited labor and the capital that can go into the home building business is going to keep home builders from responding. So we're going to have a really interesting situation where home buyer psychology has changed and people are going to want to buy homes, and that's going to force up home prices, which would normally bring a lot of new construction in from home builders. But unfortunately, they can't do it because of two reasons. One is the labor, but the even bigger issue is the banking system is largely unwilling to make loans to home builders and land developers that want to put new subdivisions on the ground. Those are called ADC loans, Acquisition, Development, and Construction Loans. And the bank regulator, the Office of the Comptroller of the Currency, has pretty much said for the last 4 years, we do not want our banks making ADC loans. So you've got a unique situation that I've never seen in my lifetime where you're going to have a remarkable increase in demand for houses because of the changing buyer psychology, and the supply side can't respond because they can't get money from the banks to respond. So when that happens, when you have that kind of change in demand with low inventories and the home builders constrained from building new product, in my mind, you have the recipe for a pretty remarkable increase in home prices that I think most people aren't anticipating at this point. Higher construction costs along the same way will push up the cost of new construction, and so I'm anticipating we'll see a surprisingly high rate of home price appreciation in 2013. That's why I'm bullish on the U.S. as a whole, because housing is a big part of the economy. What's happened with buyer psychology is that the fear of losing your job is diminishing. You've got 5 years of pent-up demand for people that want to have a different house. They want to move to another neighborhood, they've had a child, need a bigger home, they got married, get their first home, they got divorced, they got to get 2 smaller homes, one of the spouses died and they're going to move into another form of living. All of those things have been going on for the past years, and a lot of that, past 5 years, and a lot of that hasn't been responded to yet, people's postponing decisions. Fear of declining home prices has caused people not to want to buy homes. We got price increases all over the country now. And with these unbelievably low mortgage rates, it creates that positive leverage. I know you haven't heard that phrase for quite a while, but positive leverage means when you can buy a house where the interest rate is lower than the rate of appreciation. If you can borrow money with a 3.5% interest rate and buy a house that goes up 4%, that's positive leverage. You're going to get a great return on your investment. So with that in mind, I want to talk about what I think forecasts and predictions for 2013. And keep in mind, I'm an economist, so that means I may be right, I may not. That's good. I'm comfortable with that. I think mortgage rates are going to stay low through 2013 because Ben Bernanke is going to see to it. He's going to make it happen. If he has to, he'll buy them all to keep mortgage rates low. I think that the Politburo, whatever you call that regulatory agency of the banks for consumer protection, is going to develop some safe harbor rules for new mortgages, and that will make it easier for mortgage underwriters to make loans to a broader section of qualified American buyers. I think existing home sales are going to go up 10 to 15%, and I think new home construction will also go up 10 to 15%. It could go up more, but I think the constraint in the banking system is going to keep new home construction at lower levels than you might expect. I think home prices are going to increase at a faster rate than they did in 2012, and I think bank regulators will continue to stifle new lending for real estate development and construction. With that in mind, I think job growth is going to continue nationally at a slow pace, somewhat like we saw last year. The economy is growing slower than it should because there's still a pervasive fear in the business community about the uncertainty of government regulation and taxation. I don't see anything changing there. And so with that in mind, I think from the hiring standpoint, I think we'll see the private sector continue to grow at a sluggish pace, but it's still growth. And I think Congress will refuse to make the necessary spending cuts. I think we've seen some good news with the tax law that went into effect at the end of the year. We've codified the emergency Bush tax cuts that were put in place after the dot-com bust and the recession of 2001 and the 9/11 terrorist attacks. Those emergency tax cuts were put into place, and then we extended them for 10 years, and then just a month ago we codified that into law. So for 99% of Americans, the Bush tax cuts, the low tax rates in those Bush tax cuts are now the law of the land. So that's great news for 99% of Americans, those that are earning under $450,000. So with that in mind, I'm doubtful that Congress will cut spending. I don't think the American people are ready to cut spending. I don't think people on Social Security and Medicare want their services cut. I don't think farmers want their subsidies cut. I don't think the defense industries want their subsidies cut. I don't think private construction firms across America that build bridges and highways for the government, I don't think they want those subsidies cut either. The bottom line is the vast majority of Americans have a very vested interest in government spending at an increasing rate every year. So there's very few people in America that really want to see government spending lowered, and Congress knows that. And so my guess is now that we've got the tax issues resolved, we will just pretend we're going to cut spending a little bit and then walk away. And at that point, what that will mean to me is that we at the U.S. government will continue to run a budget deficit of around $1 trillion a year for the next 3 or 4 years. And so as investors and people trying to make decisions about financing real estate and the implications for interest rates, I think we're just going to have to factor that in, that our government is going to run trillion-dollar deficits for the next 4 years, and we'll just have to figure out how to make prudent investments based on that fact. I want to talk about some things about why I see the economy growing and why I'm bullish. It's not just because I want to be, it's not because I'm tired of being bearish. It's just the facts are hitting me in the face. And as we roll through some of these kind of quickly, you can see that the Consumer Confidence Index is picking up. It's looking better. Household net worth has increased a lot. I don't know if you're aware of this or not, but according to the Federal Reserve, Americans lost nearly $20 trillion in net worth in about 2 years. That's a lot of money to lose in 2 years. It went from about $70 trillion to 50. Your stocks went down, the price of your house went down, the value of your business went down. That's what Ben Bernanke's been trying to do with zero interests. That's his policy, is to try to keep interest rates low to drive the stock market higher to make you feel wealthier. It's called the wealth effect. The idea is if you feel wealthier, you're more likely to buy a house or a boat or a car or something else like that, and that creates economic growth. Well, some Americans are feeling a lot wealthier, as you can see from this chart, because as we said here today, near the end of January, stock prices are near record highs again. He's done a great job. The part that he hasn't been able to hit yet is the amount of net worth that Americans have lost in their house. This chart's pretty interesting. This is owner's equity in household real estate. This is your equity in your home. Back in about 2008, we thought we had $14 trillion in net worth in our home. 2 years later, we thought it was $6. $14 trillion in home equity reduced to $6 in a matter of about 3 years. And as you can see from this chart, it's finally starting to recover just in the last 6 months. That's because home prices are picking up. It's very stubborn though. See, low interest rates, Bernanke's had rates low for a long time now. He's got stock market back up to near record highs, but home prices aren't even close to where they were. My hypothesis, my theory is that he's going to keep interest rates low until he can push up home prices a lot higher than they are now. That, in my mind, is Federal Reserve policy, is to keep rates low, to make home prices go up and restore the net worth of America so you will feel wealthier, so you will save less money and you will spend more money and we'll start to grow our economy again. The good news is this has actually started going up. When you find out that prices in Phoenix went up 30% last year, that means that the net worth of people that own homes in Phoenix is higher than it was last year. This is kind of stubborn, but as you can see, it's beginning. And as this buyer psychology changes and a limited amount of supply, prices will continue to increase and the net worth of American households will increase, which is exactly what the Federal Reserve is trying to do. My guess is they're going to try to keep interest rates low as long as it takes until they can restore homeowner equity in their houses. So for all of us, that means it's highly likely that we're going to see pretty substantial increases in prices of homes, except in states that still haven't been able to figure out how to foreclose on properties. Consumers have been paying down debt for the last 3 years, and that's starting to change. This chart goes back to about 1955, and Americans every year always have more debt until about 2009. Then we started paying off debt. And we've been paying off debt for 2 or 3 years. That means we're not buying anything. That means we're making money and we're paying off debt. And when we do that, there's no economic growth. Well, we're about done with that. It looks like in 2013, this is actually going to go positive again, where people will feel comfortable enough to take on a little extra debt, meaning they're going to buy something. And that creates jobs in America. Households are still reducing mortgage debt. For those of you that are in the business directly of selling single-family homes and you want to know when the financial crisis is over and the foreclosure crisis is over, just keep watching this chart, because what you're seeing here is what's called deleveraging. And what you're seeing here is a lot of people getting foreclosed on their house. They used to have a $300,000 mortgage and now they have zero mortgage. So in my theory is we can't really know just how many homes are still yet to be foreclosed on across America. But in my mind, we won't feel comfortable that most of the foreclosure activity in this country is over until this chart starts turning higher again, meaning that people are taking on more mortgage debt. That means more people are buying homes than are paying off loans. This chart is nice, real consumption expenditures. This just means you and I going to the mall and spending every dime we've got. And 65% of our U.S. economy is based on you going to the mall and spending your money. And we had a little hiccup in 2008 and 2009, but you know what about Americans is, one thing you can bet on Americans is they do not tolerate deferred gratification. They just do not like not spending money. And they're tired of it and they're starting to buy stuff again. Buying cars and trucks. I heard the other day that the average age of a vehicle in the United States of America, including Texas, is 11 years. Never have cars on the highways been this old. We don't like driving old cars. We like to replace old cars. We've been postponing buying cars because of a variety of reasons. That's why car and truck sales are picking up. It's called pent-up demand, and that's going to continue as long as our vehicles are this old. This chart right here is the #1 chart that makes me feel the most bullish about America going forward in the next 5 years. This chart is the percent of your income that goes to pay debt service. That's the principal interest on loans you've taken out to buy stuff in the past. It normally oscillates between around 10.5% and 12.5% of your income. When it gets low and you sit at the dinner table and go, honey, I just calculated our debt service as a percent of disposable income and it's only 10.5%. Let's go buy something. And then when it gets up to 12, you have that same conversation in reverse and say, my goodness, we're kind of loaded up. I think we better stop buying for a while and pay down debt. And that's when you have a recession. Well, we went, as you can see from this chart, we went crazy. We went from 12.5 to 13 to 14. And at that point, I was saying we won't have a real economic recovery until we get this debt back down into a normal range. Well, I've been really surprised at how fast this is happening. I figured it might take 5 or 10 years for us to get back down in a normal range. But as you can see from this chart, by the end of 2012, not only have we got back within the normal range, we're at the absolute bottom of the range. And if this trajectory continues in 2013, we will actually have less debt service as a percent of our income than we've ever had in the last 35 years. That means people have credit capacity to buy things. You see, demand means you want something. But effective demand, which is the most important, means you want something and you have the ability to pay for it. When this chart was at 14%, you might want something, but you've got no ability to buy it. Today, with debt service at 10.5%, you've got ability to buy things. That's why this chart is the basis for my optimism going forward. The American people are going to want to buy stuff in spite of the president and in spite of Congress. Corporate profits are near record highs as well. You don't have to have a bachelor's degree to forecast job growth. In a capitalistic system like America, it's really simple. When profits are up, people hire. When profits are flat, they stop hiring. And when profits are declining, they fire people and keep firing them until profits resume again. Well, as you can see, profits are high. Businesses should be hiring workers. They're not as much as they should be because of a couple things. They're afraid of Congress, and they don't understand how much the health care is going to cost in the future because of the new health plan that we've got that's going into effect. So with that in mind, what do you do if you're a businessman or woman and you've got a lot more customers and you're afraid to hire workers? So what do? You buy machines. You see the commercials from General Electric. We're making smart machines. You see, machines don't need health care. So you have machines when you check out your groceries at the grocery store. You have machines help you check out at the hardware store. You have machines help you get your tickets at the airline counter. That's the trend that's going on in America. Your government has created so much uncertainty for the business community, they would prefer to hire machines rather than people. Despite all of this, the fact is profits are up, 5 years of pent-up demand. Small businesses, which are the backbone of America, the percent of them that say they're going to hire in the next 3 months is increasing. And it keeps increasing. It bottomed out in 2009, it increased in 10, it increased in 11, it increased in 12. These people have businesses. They have customers, and they're going to need people. They'd prefer to buy machines, but they can't just buy machines. They have to hire people. This is very bullish for the country as well. Corporate hiring is a little more mixed. Some of these big corporations, 34% of them said they were going to fire people in the fourth quarter. That could be because, again, of government sequestration. The fact that government is saying we're going to start cutting government spending pretty substantially in 2013, and a lot of defense contractors around America know that half of that cut is going to come out of their business revenues, and so they're probably making plans for those cuts in defense spending going forward. Meanwhile, most of the sectors of our economy are growing. Employment in virtually every sector of the economy is growing. The biggest drawback is in government. This chart shows how state government across America is still declining, and this chart shows how local government hiring across America is still declining as well. Most of the private sector had to fire people and right size within a year or two after the recession in 2008. But government didn't. You remember that stimulus package that the president put together back in 2009, 2010? The one where there was $1 trillion for shovel-ready projects to help America grow? And then they found out there weren't any shovels, so they didn't really do much with it other than give it to the states so that cops, firefighters, and teachers wouldn't get laid off. That was their exact wording. Well, that's exactly what happened. So what happens when that money runs out? Well, you waste $1 trillion, and then a year later, they start laying off cops, firefighters, and teachers. If we hadn't wasted that $1 trillion in stimulus, that would have happened 2 years ago, and the news would be good today. The news would be local and state governments starting to hire again because revenues are coming back. Property taxes are higher. Income taxes are up, sales tax revenue's up. The pieces are in place for local and state governments to start hiring again. It's too bad we wasted $1 trillion, but that's a lesson we've learned the hard way. I want to talk also about inflation a minute. Virtually everywhere I go anymore, people are telling me they're buying gold. And before you start buying a whole lot of gold, I would suggest that you look at some other alternatives as well, because why do people buy gold for $1,700 an ounce? The big reason is because they're afraid their government will never balance their budget, and they will run such large deficits that ultimately they will run up a debt that they can't repay. And then they will either default on the debt or, worse, print enough money so that they can pay it back with worthless dollars. That's why people buy gold for $1,700. There are other ways to protect yourself from inflation, like inflation-protected U.S. Treasuries, or buying apartment buildings, or buying farmland. Unfortunately, all those are at really high prices too right now. Obviously, a lot of people in America have no faith that their government will ever balance the budget and are making all kinds of investment precautions based on the fact that our government will ultimately print money and destroy their savings. Let's hope that doesn't happen. But I want to talk about inflation for a minute because a lot of people don't really understand it. And I find guys my age, men and women my age, if you're 45 and older, I'm 58, so don't worry about it. I'm not 45, but if you're over 45 years old, you're probably worried about inflation because, quote, the central bank's printing money. Well, let's take a look at how this really boils down. Inflation is like a car. If you think about a car, it takes two things to make a car go fast. You have to have a gas tank full of gas, and you have to have a battery to ignite the spark, to ignite the combustion. Well, inflation's kind of the same thing. You have to have a gas tank, which is a monetary base, and you also have to have a battery to light the spark, and that's the velocity of money. So I want to show you some charts here. This is the chart. When you see buy gold commercials, this is the chart you see. They go, look here, the central bank has printed $2 trillion. The monetary base has expanded by $2 trillion. That's going to create inflation. Well, that's only half the story. That's the only half you see in the ads to buy gold. This is like the gas tank. Indeed, the central bank, Ben Bernanke is the head, they have put $2 trillion worth of gasoline in the car. That makes you think, yes, this car could go pretty fast. It's never had $2 trillion worth of gasoline in the tank. But let me show you this chart. This is the one you don't ever see in the gold commercials. This is the velocity of money. This is the battery that ignites the combustion. This chart goes back to about 1959, and never has the velocity of money been lower than it is today. Let me explain. It's like a car without a battery. The central bank can print $2 quadrillion right now, and if there's no velocity, there will be no inflation. Let me explain velocity for a second. Let's suppose, just for fun, that, and I'm here in College Station today, let's suppose for fun that I'm a potter and I make a pot and I sell it to somebody in Korea for $100. Well, that $100 of income comes into College Station, and then I pay my supplier and I pay my workers, and I go fill my car up with gas, and I go to the movie, and I go get a haircut, and all of those people pay their workers. You see what happens? That $100 of income that I get in filters all through the local economy in my community, and it supports employment for a whole lot of people. The faster the money flows, the more economic activity is supported by that $100 of income. That's called velocity. When velocity is high, economic activity is high. What about low velocity? What happens if I sold that pot for $100, and when I got that $100, I went and bought a tiny little silver coin and buried it in my backyard? My supplier gets no money, my employees get no money, no economic activity at all. See what happens? I could earn $1 billion selling my pots, and if I bury it all in the ground, it creates no economic benefit except for me. And so velocity is at record low levels. Why does velocity get low? It's because people are afraid. They don't know what to do. They're afraid to expand their business because they don't know what Congress is going to do to them. They're afraid to invest in anything other than Treasury securities or maybe gold. And so they've been afraid to invest in stocks. They've been afraid to merge and acquire other firms. And because of that, they hoard cash. Businesses in America are reportedly have $1 to $2 trillion in cash sitting on their books doing nothing right now, earning nothing. That's called no velocity. The bottom line is, we've got to go back to my car metaphor. We've got a car with $2 trillion worth of gasoline in the tank, but there's no battery in it. And that battery will not be restored until the President of our country and our Congress gives positive signals to the business community to give them encouragement to engage again and invest in future growth in our country. I want to just close with a couple of graphs here that I want to show you that explain, they're just examples, but in Austin, I want to show you this chart about the inventory of unsold homes. When I was talking about that earlier, you see this red line here, it shows 6.5 months worth of inventory. That's kind of a balanced market. But look what's happening here in Austin right now. As sales are picking up, the amount of inventory for sale is near 4 months. And when we skip forward, I'll just roll through another. Here's Dallas. Dallas is setting at under 5 months. And Houston is sitting at around 4 months of inventory. San Antonio, same thing. This situation is setting up, I think, for a surprisingly good year for home price appreciation in America. And that will be good because it will create more construction jobs as we build more homes. Every time the price of houses goes up 5 or 10% in America, a whole bunch of people across America that are, quote, underwater in their mortgage will no longer be underwater. And those people can immediately go to the bank and refinance their 5 or 6% loan with a 3.5% mortgage, and they will have a lot more money to spend every month with the cheaper mortgage rate, and that will be good for America as well. So anyhow, thanks a lot for your kind attention. It's been a pleasure to visit with you today.